Welcome to this Killick Explains video on hidden costs investors need to watch. And this is part 2 of a 2-part series. So a little bit of background. Apologies for those people who saw part 1. This is a short repeat of some of that information and then we'll get into the meat of this particular video. So in background terms, charges can seriously damage your wealth. For example, if you're making 5% per year gross and fees are 2%, purely illustrative numbers, not guaranteed, your net return is only 3%, and as I mentioned in part 1, that could reduce the closing balance on a £30,000 investment over 20 years, assuming those sorts of numbers, by 40% or over £40,000. So charges matter and having a clear picture matters. Now, where can fees and charges bite into your returns? Well, in part 1, I talked about bid to offer spreads on individual securities and funds. Here, I want to focus on fund charges in particular, and then for those people wanting to see something on advisor fees, there is a separate Killick Explains video on YouTube called What Every Advisor Should Tell You About Fees, so do feel free to take a look at that one. So let's focus on fund charges here for a moment. Now, funds can charge you in a variety of ways, and by funds I mean unit trusts, investment trust companies, passive or active. So these include one-off costs such as costs to buy and costs to sell, initial or exit costs as they're known, ongoing annual management charges, usually a percentage of the amount being managed, the net asset value of the fund, and incidental, for example, performance fees. And all three of these need to be factored in. So investors should be shown key information, and including one number which is quite important if you can get a meaningful read on it, the so-called impact on returns. And that harks back to something I mentioned right at the start of this presentation. Now, the helping hand, I've called it next. So where are the rules that dictate that you should be given some assessment of the impact of charges on your returns? And the answer is a rather meaty sounding packaged retail and insurance based investment products regulation introduced in 2018, or PRIIPs for short, and thank goodness there is a short version of it. That's part of an EU investor protection regime which includes MiFID and UCITS, so it's quite a complex picture and applies across the European Economic Area. Now basically between them, those make disclosure of certain types of key information to investors in funds of most types a requirement. So what's included? Well, in summary, ongoing charges. Now quite a few people look at the ongoing charges figure and think, great, that sounds like it's the charges for the fund, but actually it's not the full picture. Those are the charges for, if you like, managing the assets within the fund, but on top of that there can be transaction costs, performance fees, finance costs and stamp duty as the underlying shares, for example, that the fund specialises in are bought and sold. And in essence, those will usually reduce your return or your expected return by a higher amount than the pure ongoing charges number. And that's where this extra bit of disclosure comes in. So how's it going to be shown? Well, this does vary slightly from type of fund to type of fund and even within fund categories. But broadly speaking, a typical disclosure of the impact on returns is a reduction in the yield you could expect to get over different time horizons. And I'm cutting through quite a lot of detail here to just give you the summary picture. For example, total costs and the cumulative impact of them on returns might be shown after, say, 1, 3 and 5 years. And the cumulative impact is important because every time costs are removed from assets within a fund, that impact rolls up over time. This all sounds pretty useful. So it'd be great to understand the total costs and the cumulative impact on returns over different time horizons as a reduction in my expected return. If you like, an elaboration of the point I made way back at the beginning of this presentation, but there are a few challenges if you think this is just going to be a very easy and quick way to understand different charging structures. Why do I say that? Well, first of all, the regulation in this area, the key bits of regulation, don't all agree on exactly what should be disclosed for each type of fund, and PRIIPs goes wider than just funds. It covers banks, insurance companies and so on. And key information document critics say that the result is you're trying to distill a very complex picture into an overly simple one. So the key information document sort of falls awkwardly between two stools. Almost not enough information to pick up all the subtleties of the way funds can levy charges, and too much information for many investors who are new to the funds world. And then on top of that, Brexit could change the regulatory landscape for packaged products. We're in a kind of holding period at the moment, so it's a case of watch that space in terms of the extent to which these EU regulations, which the UK in fairness had a heavy hand in designing, I should say, but the extent to which they stay in place. So conclusions for investors from all of this would be what? Well, first of all, fund charges are complex, too complex, many would argue. Different funds may make slightly different disclosures under the rules, and that may be because they can, or it may be because they feel they're able to. So I would suggest you do need to understand fund charges. They can eat into your total returns. The impact on your total returns is important, so the best bet is to ask an investment manager to explain them to you and make sure you've got the full picture before investing. Any questions on what is, I admit, quite a meaty topic, editor@Killick.com, and to watch videos on funds, open-ended, closed-ended, ETFs and so on, then Killick.com/learn, and the funds tab is a good place to start. And if you're completely new to investing, you might consider a copy of my guide, How to Invest in Equities, which covers the fund route versus the direct portfolio route, and that's also available at editor@Killick.com.